I'm Peter Resnick from ShadowTrader.net, and this is the Weekend Edition. In today's show, we're going to try to answer the question, is the market crashing? Which I think many people are asking themselves after they saw what happened in the stock market on Thursday. As far as I'm concerned, I'm a short-term trader. I really don't hold much wealth at all in long-term equities. However, the percentage of Americans who own stocks is 61%. So I guess this one's for you. Let's go to the charts. So what exactly happened this week in the market that might have people thinking that we might be topping or that there might be some sort of crash scenario happening, or at the very least, some sort of a larger correction than we've seen? Well, it all comes down to the market's action on Thursday, where we had a very large bearish engulfing candle. I'm going to get to that in a second when we look at the charts. But first, I want to show you what the market internals under the hood were looking like on that particular day on Thursday, because they were more bearish than we've seen before. And what happens with these types of days is that they need to be carried forward in your narrative, because the bearishness doesn't always happen right the next day. As I'm going to show you soon when we go to the charts, there's a certain amount of, like a little bit of a lag effect, if you will, that it takes a little bit of time for that to wash into the market, where stronger sellers may come in after that reference day, as we call it. But this is the market internals that I'm showing you here on that particular Thursday of this week when we had the large down day. And again, the main reason why I want to show you this is that it was different. There was somewhat of a paradigm shift here in terms of what these numbers look like on Thursday and what they usually are. One of the things that we've been discussing a lot on this program, and I talk about it pretty much every day in the weekly options room that I run, is when the sectors are either convergent or divergent, running together like this, or pulling against each other. Most of the market that we've seen recently for quite a long time has been a lot of push-pull, where there's sector rotation of money going into technology, out of discretionary, or you name it. There's whatever's going on in these 11 sectors, it's an immense amount of push-pull. This action on Thursday was all pushing in one direction. Notice that when these sectors here, which are measured from the open, are all dark red colored, these colors, this is dynamic, I have this set up so that they change either a pink to light green, dark red. Dark red tells us that the sectors were down more than 0.5% from the open. Notice that all 11, and they got hit pretty hard. Technology down almost 2%, healthcare 1%, financials 1.36, etc. And again, important thing to remember, these are measured from the open. As short-term traders, that's all you really want to care about. Don't think at all about the numbers that the news is showing you, or anywhere on the web, or if somebody says, oh, how much is the S&P up or down? Doesn't mean anything. It's all the action from the open that matters, and that's why I keep my focus there as much as possible. If you look down here, this is the weighted AD, which I've always been saying is absolutely worth its weight in gold. It is a pictorial representation from the open in a histogram format of what these 11 sectors are doing, but weighted by the amount of weight that they have in the S&P. So these 11 sectors are not equally weighted in the S&P. As you can see, technology has almost 30% of the weight of the whole index. Healthcare has 12.4, financials 13.3. So just in that beginning group of 3 or 4 sectors, you've got half the market. And that's very, very important to note, because you can often have a market where, for instance, so let's say real estate, materials, and utilities, they're the only ones that are down, but the market is up pretty good, because en masse together, those sectors make up like 6 or 7% of the market. So that's important to know. So these numbers here, I don't pay too much attention to the absolute number. I'm more thinking about the pattern, when it goes positive, when it goes negative, as I'm watching the markets unfold every day. But I do want to add into the narrative here that this number here was pretty weak. This is about 540 negative number here, showing you just how deeply those sectors were moving off the open. So there's definitely that. In the upper left-hand corner, first 2 boxes, that's the breadth. It was 6-to-1 negative at the close on the New York Stock Exchange, 1.83-to-1 negative on the NASDAQ. That's not that weak, but we've seen some relative strength in NVIDIA and other names. Obviously, NVIDIA reported on Wednesday night, so that has a lot to do with this, right? Which also, just while we're on the subject, I find extremely fascinating. We'll talk about that as well, how NVIDIA reported on Thursday, huge gap up, held the gap, and actually went higher, and yet the market was down so much. So that's also something I think to sort of bring into your narrative, that there may be, as far as what I was saying in terms of like a paradigm shift, because this is a market that has been following NVIDIA for a while, and here NVIDIA was strong and it didn't care. It went down anyway because all the other names were selling. Continuing on, Advancers were losing to decliners by a margin of 1,922 on the New York Stock Exchange, and on the NASDAQ, 2,304. Those are solid numbers. Anytime the advanced decline line is minus 2,000 or more, that's something to pay attention to. So just wanted to start with this before we get into the more technical side of things on the chart and show you what was going on under the hood on Thursday, because I do believe, like I said, it was an important day, and it's even more so, even made more important, I think, by the fact that these numbers were confirming that on that particular day, the selling was pretty heavy, all right? Let's go over the charts. We're gonna go over to a daily S&P now on a relatively long time frame, and as you can see, I've purposely boxed off a couple of important areas. And the reason I did that is because I think that there is historical precedent here that we've seen 3 times before just recently in terms of what happened on Thursday. So what happened on Thursday was essentially the very large bearish engulfment candle, right? Bearish engulfing simply means that you have a large body candle, and inside of that candle to the left of it are multiple bars from prior sessions, so that the one big day sort of engulfs all of the activity. That tends to be a longer term bearish signal sometimes, and that's what I wanted to show you on these charts, that we do have some historical precedent for how this has played out recently. If you go on this chart all the way back to here, which is July of 2023, you can see here, it happened here, there was a couple days higher, and then the market moved lower. It happened here again in December of the same year. Here, it went higher actually for 5 days and then moved lower. Not a big move, but it did move lower. It happened here, which was April, just recently of this year. Again, big candle, went sideways for a couple days, and then moved definitively lower, which brings us to where we are now. 3rd week in May of 2024. So the question is, will this pattern repeat? The chances are there that it does, right? So far, it's actually playing out in the exact same manner, in that if you look back on a lot of these days, pretty much almost all of them, the day after the bearish engulfment was actually a bullish day. And it was the same exact thing today. If you look closely here, on Friday, May 24th, we had a bullish day. So for next week, what we need to be watching very closely for is how this plays out in relation to what I'm calling that reference bar. Remember, Thursday is the reference bar because we are going to reference the highs and lows of that bar. If we move above the high of Thursday, buyers remain in control. It was a fake out, nothing to worry about. We probably grind higher. But if we do see this same thing play out that we saw 3 times relatively recently in the last year and a half or so, there is potential then that we will start some sort of a move lower. And again, we want to see, do we stay within the confines of the reference bar on the bounce? So far we have on Friday. Let's see what happens on Tuesday, Wednesday, etc. To me, if we roll over like we saw in some of these other days, the stronger short signal is probably going to be at the low end of the reference bar. That's how it happened here in April. If you look closely, you draw the line on the low of the reference bar. After it had the 2 or 3 days of bounce, once it came down to the low of the reference bar, that's when the more accelerated selling started to happen, okay? So we've got plenty of precedent here to go on, and let's see if it plays out the same way that it has as of recently. I'm going to be watching that reference bar and its highs and lows very, very closely in next week's trade. Time now for our sector spotlight, which this week is probably one of the most boring sectors out of the 11 S&P that I just talked about in the prior screen, but it hasn't been too boring lately. It's utilities, if you haven't guessed. The XLU is the sector spotlight this week. This sector has been on fire lately and has been showing an immense amount of relative strength. I am long XLU myself. I've been long it for about a month, maybe a month and a half now. It's doing really well. But I'm going to show you soon when we get into the charts that I think there's a lot of gas left in the tank still, and I think this could be a really good trade for potentially rest of 2024. Let me show you this comparison chart here that I put together, showing the action in the XLU versus the S&P and the other sectors. So let me just explain what all this spaghetti is, because obviously it may look a little bit convoluted, but the bar chart that you see all the way here, the OHLCs, which is the red and green, that's the S&P 500 on daily candles. And this chart is purposely a year-to-date sector comparison. That means at the beginning of the chart all the way over there, where all the blue lines converge and sort of spider out from there, that's January 1st of this year. So just keep that in mind. And what happens is from that moment, we take the percentage return of the sectors, how well they're doing, and it just starts plotting from there. And the S&P also starts from the exact same point. The white area here, which is the white OHLCs, that's utilities. So you can see in the beginning of the year, they really just kind of meandered lower, and given that the red and green is the S&P, it was obviously relatively weak, as they usually are. Utilities are not going to perform nearly as well as the S&P, and it's very rare that they outperform. So they're kind of just meandering along, and then right around here, notice what happened. Utilities start playing catch up, and right in here is where we started getting long, still holding, everything's good, and you can see here going up, 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 and look, right in here in the chart, there's actually areas where the utilities are actually outperforming on the year as far as the S&P is concerned. And I've purposely labeled all the 11 sectors here. Notice that only technology and communications, when I made this chart, which was actually yesterday, are here above the market in terms of their performance from the beginning of the year. But it's very, very noteworthy that utilities are actually just underneath that. As I was saying, even for the utilities to just be running on par with the S&P is very, very bullish, and we don't see that often. So it's just something to think about. Again, I think there's more gas left in the tank, and I'm going to show you in the charts right here as we move over why I think that. So this is the pictorial representation, obviously, of the daily chart of the XLU. I've purposely put some Fibonacci on it from when that bottom move started here, just to show you where the pullback might come in. 63.85, that would be the first retracement, 61.72, like a 50 and a 61.8. But notice the bullishness here. And again, simple TA of the 8s and 21s here that we look at most closely, right, where we're always thinking about our 8s and 21s where we're at. We're just now pulling into the 8, and we haven't even pulled into the 21. So I think there's plenty of room left in the tank here as far as going forward. Certainly this 21 here could be a buy point. Again, I'm thinking this is kind of a trade that's going to develop over the course of the rest of the year. This is really a play on rates. I know that it's been nebulous lately. The Fed has been relatively transparent, and they're always saying we're pushing it out further. There's really not stronger odds of a cut yet this year until September, and that's about a 50-50. Even that might not happen. But remember, the market tends to be ahead of things, and that's what I think is happening here, that I think this sector is strong, anticipating the cut in rates. Utilities kind of act like bonds in that manner. They're heavily indebted in order to be able to fund their operations and grow and do what they need to do, and thus, as rates come down, these tend to do better, and vice versa. So in a higher interest rate environment, utilities were weak. You can see over there. So I just showed you they were underperforming for a while, but now they've started outperforming a lot of the sectors. So again, XLU I think is the play. I can't really show you anything on the options front because it is optionable, but relatively low implied volatility. There's not that much there. It's not that expensive. You're talking about 70 bucks a share. If you want to get some leaps and buy some deep in the money calls and get a little bit of a discount on that $70 a share, you certainly can. But again, when all is said and done, I think utilities will continue to be strong this year. And again, this pullback to the 21 might be in play, or start looking at some of these Fibonacci references that we have just below us in terms of the pullback of this entire move. Time now for our number one draft pick. This is the portion of the program where I leave you with a solid trade idea for next week. And this week is Lululemon, which surprisingly enough, you may be thinking, because if you have been familiar with the price action of Lululemon recently, you will know that it has been horrifically bad, but that often sets up short-term trading opportunities if you are nimble. So that being said, let's take a look at this chart. I want to start this off on the monthly actually, just to show that we have now come into an area of support on Lululemon. So of course the price action here has been horrific. It's been about 1, 2, 3, 4, but it's been about 5 months of solid selling after making that new high there just over 500. And where is the stock coming into now? Look at this, right into here where there was all this monthly congestion, kind of the low end of that monthly congestion. So I would expect that there is a demand area in here that at the very least is going to give us some positive price action moving up shortly. So that's what we're looking at. So if I switch this chart over to a daily, and now I'm going to show you what exactly I'm looking at. I want to point your attention to what's been happening right here over the last couple of days. And the reason why I'm showing you that specifically is because there was a gap down, and since then the stock has not been able to materially move lower. You'll notice that the second day after the gap down, which was a couple days ago, did not made a lower low, but only incrementally. That's always very important. Whenever a stock makes what I call an incremental lower low, meaning you have a support level, you lose the support level by 10 cents or something and go back up, that should make the hair on the back of your neck stand up. That tells you that the sellers were not there. They thought they could get it lower, but they could not. So that's the first thing, went lower. Then we had this kind of doji candle today on Friday the 24th, which does what? Leaves us with potential area to run into the gap, which is just above the 310 area. The gap essentially is about 310 up to 320. Again, this is a short-term trade. I don't know if this is a longer-term bottom in the stock. This is a short-term trade idea for next week. So if we look at how potentially we could play this, hitting our Analyze tab here, I set up these couple of butterflies here on the bottom. This is probably how I would look at this in terms of where I would be a buyer and where I would be a seller for next week. Now, major caveat here on this is that the stock needs to break up into that gap in order to put any of this in motion. If the price action remains weak and I don't see some action up over that high, which would be the high of that gap down day, then all this is moot. But if we can move into that area, I, for one, would probably be looking at butterflies. I think there's two different ways you could play it here. You could go tighter and use the $5 wide, which would be this one here, about a 310, 315, 320. That would cost you about 51 cents, which has a max value of 5. Not bad, pretty good risk reward. Or you could go a little larger and get the wider one here, which is, you don't see it on the bottom of the chart. I need to move it up, but it's 310, 320, 330. And that'll run you about $1.13, which is better risk reward, I would say, because you're looking at about $1 of debit potential gain there of 10. So that's kind of the way I'd be looking at Lululemon. You could easily, obviously, also buy the stock with a tight stop as it moves into that area. But for me, I like to utilize the structure of butterflies because what it does is it gives me directional exposure for a lot less debit outlay. Obviously, it may sort of curtail my return on the back end, but the way I like to look at it, I would rather take that trade-off for less risk, all right? If you want to see this type of trade and any of the other type of esoteric spreads that I've been doing for many, many years with an extremely positive track record, check the description down in the link below, shadowtrader.net/options. You can trade live with me every single day of the week in the weekly options advisory. And that's our show for today. Thank you so much for spending a little bit of your weekend with me. Let's recap some of the salient points of what we discussed in this particular program. Is the market crashing? Maybe. I mean, we're going to take it bar by bar. There's something in trading called bar by bar analysis, and I'm a big believer of that, and I think that's what we need to be doing. But the main thing to consider going into next week, which is a shortened week, by the way, Monday the markets are closed, but in that shortened week, pay attention to the reference bar as we talked about it. That's the Thursday bar. The high and low of that bar are going to be very, very important, and you want to keep in mind that there is historical precedent, as I showed you on the charts, for the market to move lower in a couple of days after we print a bar like that, all right? Watch utilities on the pullback. I think XLU is a buy on the pullback. That Lululemon I showed you could be in play, but really only if it breaks into the gap and only if the market remains bullish. Remember, most stocks follow the market. That's my MO. That's how I basically trade, is I do everything aligned with the broad market whenever I do my own trades. So if the market rolls over, you probably just want to ignore that type of play, all right? Next week is going to be the end of the month. We're going to get into some monthly charts, which should be exciting. We'll see how the month of May finish out. And we'll also have another edition of Should I Do This Trade? So email me next week around Wednesday or Thursday or Friday if you like. And hopefully if I choose your entry and we go over the options play and see if you indeed should or shouldn't do this trade, you will get a free month of the weekly options advisory, all right? Coming at you from beautiful Los Angeles, California, another one in the books. I wish you good trading and good night.